Hey, good morning, traders. It is Monday, June the 9th. First thing I want to do, though, is check that the sound's working because it doesn't look very promising on my end. If I go here, the trading room, and apologies if you guys can hear me. You guys hear me this morning? Check that the sound's working because it doesn't look very promising on my end. Got it. It's working. It's working. Excellent. Excellent. Right. Good morning, traders. Monday, the 9th of January, 2023. James here, stepping in for Steve Miley. And it is CPI week. So all the focus to the most important figure of the month, which is CPI, dropping on Thursday. Expecting a little bit of a maybe bullish bias, but slight chop fest, and eventually any sort of volatility tailing off before then. But yeah, hello. I think this is my first meeting of 2023. And well, I know it's my first meeting of 2023. It's been a while, and it's actually really nice to be back. It's nice and cold here in Chicago this morning. For those of you who think in Fahrenheit, we are, I think, around sort of 20 degrees. Is it? Let's have a look here. Anyway, it's really cold outside. I was speaking to my mum and dad yesterday, who are in England, and they told me that it's been cold and wet, but actually quite mild, really, for Europe, which is a good sign for European inflation because gas prices are coming off. The winter is not as harsh as everybody expected over there, or that it potentially could have been. So far, remember, we're only early into January. But generally speaking, what's happening, from a market's perspective, is that gas prices are coming off, and of course, gas was a huge inflationary factor in European inflation. So, the market kind of seems to overall be feeling quite positive. Certainly the start to the year in Europe was very positive. I think it rallied quite a lot last week. And compared to sort of the chop fest we had here in the US, but from Friday's non-farm payroll data and some of the other data releases, the stock market got a rally, and that's kind of continued into this morning a little bit. Why did the stock market rally on good news when all it's been doing is selling off on good news? Because good news represented an inflationary situation. We had good jobs data on Thursday, market sold off. Good jobs data on Friday, market rallied. It's a mystery. We'll get into it. We'll look into it, and we'll go through, some thoughts that I have, and some of the research or data that's been released over the weekend. Let's just grab a cup of tea here. So, looking at the daily economic calendar. Actually, before we get into this, let's get into Steve's weekly sort of summary, our Sunday 6 that we send out every Sunday, which is you should be dropping into your inbox, and it is just a summary of what happened last week, and and what potentially we're looking for in the next week. And I always like to read this. It drops in on Sunday. If I don't grab it Sunday, I'll certainly read it first thing Monday morning. But let's have a look. A busy start to the year on the macroeconomic front from the US saw the Fed minutes echoing recent Fed statements and comments from Fed speakers that interest rates would need to go higher than markets were pricing and stay there longer. It does seem to me that the markets are fighting the Fed a little bit here. So I don't know how much more upside there is ahead of this CPI number. Obviously, a softer CPI number this week means that the markets have got it right, and that or potentially I've got this like recent rally right, and that there might be room for the Fed to get less or stay as hawkish as they are. But at the moment, they're still holding their ground, and that's why this week's CPI number is very, very important. We've got the ADP's private sector jobs data. So that's the jobs data on Thursday, right? It showed an increase of 235K for December, significantly above expectations. Now, that, of course, caused the sell-off on Thursday as people were like, oh, no, the market's too hot. The economy is too hot. Perhaps rates will have to stay higher longer, as the Fed keeps warning us. And then, of course, we had non-farm payrolls data that increased by 223, again above consensus expectations. Let's just roll this in here, because it says the unemployment fell to its September 22 post-pandemic lows of 3.5%, while average early earnings were up 0.3% for December. Now, the market rallied off this. Why? Well, I think what happened was, with the very, very big ADP number on Thursday, the consensus that we were looking at going into Friday for non-farm payroll, it beat consensus, but the consensus would have shifted between Thursday and Friday, because of the high number on Thursday would create a lot more sort of feeling that the number on Friday could be higher. So, this came in higher than consensus, but, had the market already sort of priced in an even higher number. And the other part of it is the average hourly earnings, which is an inflationary part, right? The average hourly earnings was down. It was below expectations. So that's good from an inflationary point of view. But the big thing for Friday was the ISM Purchasing Managers Index data for both manufacturing and services were both below expectations. Okay, so they dropped into contraction. One of them dropped into contraction. I'll touch on that in a little while. But generally speaking, unemployment is considered a lagging indicator, meaning that it's lagging behind perhaps where the economy is today by the time it takes to compile it. Whereas ISM or PMI data are considered leading indicators. This is an indication of where the economy is going. So the fact that they dropped into contraction is very good for our inflationary outlook. It means that inflation should slow, which again means that the Fed can become less hawkish, and rates probably won't have to stay as high for as long, meaning we could have a soft landing before our recovery starts, rather than a full-on recession. So that's kind of why we saw that price action on Friday. Obviously, very, very sort of easy to talk about in hindsight, much harder to trade. I know it caught me. I know it caught a lot of our traders. It was a very tricky day. It's been actually a very tricky start to the year. Global financial market developments. Major US stock averages were modestly positive, with a consolidation range to start 2023. So that was the US, a bit of a chop fest. We'll have a look at the charts in a moment. European equity indexes posted a positive start to 2023, outperforming their US counterparts. I think that's got a lot to do with the milder than expected winter. And Asian averages were mixed, with Japanese indices lower and Chinese markets rallying, probably because of China opening up and relaxing their COVID restrictions. So drops in your inbox every Sunday, always worth a read as we come into the week to set us up for the week. Let's take a look at the monthly, or not monthly, what am I talking about? Daily calendar, daily economic release calendar. In fact, let's have a look at let's do this. Let's look at the weekly calendar ahead, because we are, so you can see, if you're on the daily economic release calendar, you can see here's a drop down, and you can go this week, and we can actually just have a look at the week in one snapshot, and you'll see that actually today, very quiet on the data front. Okay, nothing really here. There's a couple of small European numbers. We have nothing really out of the US. It's a very quiet data day today. And as we move into tomorrow, we do have Fed Chair Powell speaking. So keep an eye out for that. That's very important, always important. Never know if he's going to go off topic or off piste. Unlikely, but definitely worth keeping an eye out for that. And then as we move into Wednesday, there's a bunch of US data, but it's all kind of minor. I mean, obviously, if you're trading crude, you've got the crude oil inventories. But everything else, is one head or two heads worth of. This is the key, by the way, for our new traders. The three bulls heads, I think they are. represent a data release that's important and one obviously less important. So you can see there's nothing out, and what all eyes are to are the CPI here on Thursday. The most important data release of the month. Okay, so very light on the data front today. Let's have a look at the global headlines. Go over to Reuters. There is an article here about Goldman Sachs to start cutting thousands of jobs midweek. Now, this, it's kind of indicative of what's happening with a lot of big companies at the moment. So you've seen it a lot in the tech sector. I think people like Amazon and Facebook have made big headlines in recent weeks about making huge job cuts. These are companies that are preparing for a tighter environment, a more difficult trading environment as we go into 2023 and 2024. The markets are anticipating, obviously, a slowdown in the US economy. Is it going to be a soft landing? Is it going to be a full-on recession? Nobody knows, but people are preparing and they're cutting back. Now, it seems like Goldman Sachs are following suit here, but one thing to note about Goldman Sachs is that they make a job cull every year. This is part of how they operate. So what they do is they tend to overemploy, and at the end of the year, cut the sort of 25 to 30% weakest members or the least performing members of their teams. And that's the way that they sort of I guess stay strong. Part of their evolution, if you like, culling of the week. It sounds harsh, I know, but if you work for Goldman Sachs, you get paid a lot of money, so you have to pay that price for that uncertainty. But they didn't do that over COVID. So, believe it or not, Goldman Sachs found a heart over COVID and actually didn't do the job culls in 2021 and 2022 even. So they're just playing catch up a little bit here. So is that? I mean, I think you can say that it's partly catch up and partly an expectation that things are going to be tough for the year. But I don't know. I think it's more just playing catch up. And apart from that, there's not really much out. There is this morning bid seeing through another shock. So the morning bid, I don't actually read Reuters that much, but I think if you've been following Steve, they might have this every morning now. And it's, when I had a quick look at it, it just seemed like a very good, nice summary of what's been happening in the last few days and maybe what's coming out over the week. So, Brazil weekend political shock. So the former far right president, Bolsonaro, his supporters stormed their capital, like what happened here in the US on January the 6th. So it says here, Brazil, the world's 12th biggest economy, was jolted on Sunday after supporters of former far-right president stormed government key buildings, echoing the Jan the 6th, 2021 Capitol riots in Washington. It hasn't really rattled markets. Here we go. The alarming development failed to derail a more upbeat start to the first full trading week of the year in other major markets. However, a positive take on Friday's US unemployment report for December and China's reopening of its borders after years of zero COVID restrictions. Right, that's what's giving the markets a bid. Asia and European bourses climbed and US futures were higher ahead of their fifth session of 2023. So here's something kind of interesting. You sometimes hear these sort of market sayings, reminding some of an oft-cited 5-day rule, which suggests US stocks tend to gain for the year ahead if they are net positive after 5 days. So if they're net positive after the first 5 days of the year, then so goes the rest of the year. Although the US payroll report showed labour markets remaining tight, readings on wage growth and a surprisingly sharp downturn in service sector business confidence last month encouraged those betting on an early peak in Federal Reserve interest rates for the year. Okay, so that's referencing what I just talked about at the start of the meeting, that the PMI and the ISM numbers were worse than expected, and they're leading indicators. And That's giving markets a little bit of positivity. Let's move on from here. And we are at Forex Live, another site that we like to take a look at. And I had a look through the headlines. The only thing that was sort of really, no headlines stood out. But the one thing I wanted to open was, again, another sort of weekly outlook that they throw up on a Monday. Last Friday was incredible, not because of another good non-farm payroll report, but because the ISM, and PMI showed a huge dive into contractory territory. So this, I believe, is a Bloomberg of a ISM services. So this is a Bloomberg chart, and if it's below 50, it represents, if the number comes in below 50, a period of contraction. If it's above 50, a period of expansion. So you can see it's been above 50 for quite some time. Boom, and a big drop below. So the labour market, which is a lagging indicator, remains tight, and that will keep the Fed uncomfortable in easing monetary conditions. Remember that they see 4.6% unemployment this year, keeping rates at 5%. All right, so that's what they see. But if we look at the leading indicators, the Fed may very well over tighten and act too late when unemployment starts to shoot up fast. The market took this miss in average hourly earnings. Okay, so remember we talked at the start of the meeting, that part of the Friday data, the average hourly earnings was softer than expected, which is deflationary. So the market took the miss of the average hourly earnings and the big miss in ISM and PMI as good news. But I think the reaction was wrong by this analyst. There is hope among participants that the recession will be mild or short, which makes a deep recession an out of consensus call and something that is not priced in. That's where we are going, in my opinion. Okay, so that's interesting here. So what he's saying is, right, there's a lot of sort of early good news or early feeling, positive feeling now being priced into the markets. So, the expectation going into CPI is that the number will be softer on Thursday. Right, we had a softer print last month. It's going to be softer on Thursday. If that number comes in hotter, all bets are off. I think we'll see a huge sell-off. If it comes in as expected or slightly softer, I think we'll see a little bit of a chop, maybe some small bullish to the upside. But if that comes in any way hotter, the risk reward is to the downside, right? The risk is to the downside. And if you're short, that will yield better profits than if you're long, I believe, and it's a softer number. So that's what I mean by that sort of risk reward. So we're looking ahead to the Fed, to the CPI number on Thursday. Don't think there's anything else here. There's a high conviction in the bonds. This guy feels strongly that we are about to see a strong bull market in bonds. Fighting the Fed is usually a bad idea, but at tops and bottoms it can be done, and the bond market is, in my opinion, will do that. The market expects rate cuts by the end of 2023. I think rate cuts will be bigger than the market currently expects. Let's have a look here. What else have we got? This is, I think that's it. That's it. That's all I have for the news today. We have trading advice and tips. You know what? I'm going to leave this. I'm going to ask Steve if I can do tomorrow's webinar, just because I want to talk about this blog piece that I wrote last January about how you can access it from our trading advice and tips, and I want to talk about how how difficult trading can be in January, particularly for day traders. But I want to go into it, and it can take me probably about 20 minutes to go through it. So I don't want to tack it onto today's meeting. I don't think I'm going to have much to talk about tomorrow, given that there's no data out today. So it'd be a good idea if we can do this tomorrow. Just a couple of other things before we move over to the charts. Actually, let's go to the charts now, and then we can wrap up the sort of a technical and fundamental outlook, and then I can do a couple of housekeeping bits before we wrap up the meeting. So this is the S&P daily and an S&P hourly. and we can see this is the big rally off non-farm payroll. Incidentally, I was looking at this, and this big green reversal was the CPI number for October. And this big green rally number was the CPI for November. And this big green kind of reversal day, we're open here, rallied up and sold off, hit this level of resistance here perfectly and sold off, was the CPI for December. So, this just goes to show. I think Steve's going to talk more on Thursday morning in the meeting about, CPI from a technical perspective. So tune into that meeting. But, we can see here, let's have a look. Let's see if I can spread it out. So, this was the start to the year. Oh, my God, it's awful. It's just a huge chop fest. It was very, very difficult to trade last week. A lot of funded traders lost money, unfortunately, and a lot of our valuation traders also blew out. So not a good week for trade days traders, I'm afraid. Let's hoping for a better week this week. We can see we're sitting right on this level of resistance here. My feeling is, given the sort of momentum from Friday and that we've kind of broken through these highs that were established, I think we could probably push a little higher. But I just don't know how much higher we can go from here. Ahead of CPI, maybe sort of halfway between this level of resistance and this level, what will become a level of support. So if we break this resistance, it'll become support. So maybe sort of kind of up to here. If it fails, I think it's not going to break this sort of downtrend. There's no data to suggest at the moment that that it should break these lows at all, particularly after Friday's data. So my bias is for the upside, but honestly, I just don't think we're going to do much up until Thursday. I'm looking at it here. I think these kind of levels, sort of here, somewhere around here to here, are going to hold. To be honest, that's my feeling. If they do fail, maybe down to this level here of support, but it will be very, very difficult to undo this sort of bullish rally from Friday's data ahead of the CPI. And then, if we break back up towards, maybe up to this psychological level of 4,000, I doubt it though. Let's see. Let's see how the day unfolds. Honestly, I don't really have much conviction on the day. This is the NASDAQ. The NASDAQ's sitting on its levels of resistance. So that's kind of interesting. Sorry, my bad. We are sitting on levels of daily resistance here in the NASDAQ. So it's got some work to do to get through here. Obviously, the S&P is also sitting there. I think, if it was me, what I would do is I would wait to see if it breaks these levels. And if it breaks these levels, then I think it's going to march up towards this level of resistance here. But I don't think it's getting much ahead of it. Much ahead there once again. Gain on these levels of resistance. It could fall off. If it falls off, I don't know. I don't see it going through Friday's lows. I'm sorry, guys. I just don't have much conviction on the charts today. I'm very much a fundamental-driven trader. I'm looking to Thursday for the market to sort of gain this sort of trends and direction. I'm not going to be really sort of dipping in and out. It's rare that I actually do much day trading these days anyway, because I'm just so busy managing trade day on a day-to-day basis. These are the treasuries. Treasuries seem to be in a nice bull trend at the moment. Got a bull bid off the Friday data as well. And then gold, and this is oil. Oil's trending down. It's got a bit of a bid this morning. We can see that. It's got some levels of support here. Kind of around here. So we get a bit clearer. But it looks like sort of, that must have been from back here, these kind of levels. So it's $77.25, around $77.25 is going to be your first level of resistance in oil. Once again, I just don't. I guess we got the oil reports, inventory reports on Wednesday. Maybe that'll do something. And then gold. Gold's got a nice strong bid on the year, right? Looks like it's heading comfortably up towards sort of $19 and $1,910 a troy ounce. Looks like it at the moment. So, I'm not a technical analyst. Steve's our strong guy on technicals. If you are really looking to get some insight into the charts, guess what's coming up this week? We have a technical Tuesday. So head over to resources, Technical Tuesday, where Steve runs a live webinar tomorrow. He's doing it at 7 a.m. Chicago time, and no, that's wrong. That date and time is wrong. It's happening tomorrow, and it's happening 4 hours. So it's going to be what's that? That's going to be 7. It's going to be 11 a.m. Chicago time, 12 p.m. Eastern time, 5 p.m. UK time, 6 p.m. Europe. All right, so Steve's going to be running a 1 hour, so I don't think they're an hour, they're about sort of 30 minutes, live webinar where he talks about different charting tools and charting tools that he uses, a bit of a deeper dive into technical analysis. So if you're new to technical analysis, we have a free course in our free courses section. This is a little bit more of a sort of a real-time deep dive, answering your questions, a live webinar, and we record them and we archive them on the site. So you can see here the first week was about Dow theory, chart levels and trend lines. Second week was overbought, oversold indicators, momentum, divergence and confirmation, and trading signals from indicators. I don't know what he has in store for us tomorrow, but there is a Technical Tuesday tomorrow. I'm going to leave it there. Actually, no, let's have a look, because I think Steve and I agreed on a Trader Mind session as well. Our next Trader Mind session is actually next week. Forget the date. I'm going to change the date. The clocks have been changed correctly, the countdown clocks. So 9 days. So it's going to be next Wednesday. So next Wednesday, Steve and I will be doing a Trader Mind session. We'll be posting in the forums and on the site, giving you guys plenty of notice ahead of that. So it'd be great to see some of you at the Trader Mind session. Other than that, I'm going to leave it there today. My first meeting, not only of the year, but in a long, long time. I'm going to do the meeting tomorrow because I want to talk about that January challenge that people find, particularly day traders, coming back in January and finding it very difficult. And I think we saw a lot of that in the week. I mean, the markets did not help, but that is part of it. There are structural issues afoot in January, which we can talk about tomorrow too. So I'm going to ask to the session tomorrow. So I'll see you all tomorrow. We'll run through the data again tomorrow. We'll run through the charts, and we'll have a focus on what trading is like in January. So thank you. Have a great trading day, traders. Stay safe, stay warm, and I'll see you tomorrow.